Talking to our friend Bill Halick, and we're going to go over what's going on with this banking crisis in the States and how it's going to affect what's going on in Puerto Rico. And we already had a liquidity problem in Puerto Rico, so we'll get into that. This isn't going to help, that's for damn sure. But hopefully one day, Bill Halick and his team are going to bring liquidity to the island of Puerto Rico.
Yeah, I mean, this whole thing is bonkers. So SVB is the Silicon Valley Bank, which it's a bank for investors in the Silicon Valley, and a lot. I don't know the stats. You guys can Google them, but basically, you know, FDIC covers insurance $0 to $250,000, right? So if you have money in a bank account under $250,000, typically you're covered by the FDIC if the bank were to fail. That particular bank, I think 94% or some huge number of the assets in the bank are well above the $250,000, because there's a lot of well-to-do tech people.
Yeah, it's big business, right? I mean, it's the who's who. I think lots of crypto, lots of startups, all of that tech stuff out there on that coast.
Yeah, I think it was a bank I think the bank was started by tech people because they weren't able to get traditional banks to fund them for some of their startup type stuff. So I think that's actually where the bank emerged. It's got some of the big players behind it, blah, blah, blah. It was an actual traditional run on the bank. But the difference here, think about it, a bank run back in the day, the term, if I understand it correctly, is you're running to the bank, physically running to the bank to pull your money out because you're worried that the bank is going to fail, so you want to take your money out of the bank. Yeah. So you actually had to go to the bank. But in 2023, you just go on your iPhone or your Android, press two buttons, and you've just sent all your money to your other connected account that has nothing to do. So it's a digital bank run. It happens so much faster. And if you go on Twitter, you can find there's all these people that had their money in SVB, and they were like, you know, one guy finds out about it, it's like a game of telephone, and the next guy knows it. All of a sudden, all the people in the
everybody's withdrawing their money from this bank, and it was billions of dollars, right?
Exactly. So it was a run on the bank that happened digitally, kind of. I don't want to say overnight, but it was very fast. How fast it went down, and I think SVB. I have to look and see if they've done something now. I think the Fed came in and said they were gonna backstop everything, which they're claiming it's not QE and it's not a bailout. You know, but at the end of the day, if you're replenishing people who lost money, it sort of is a bailout in a sense. I think there's a bunch of graphs going around showing that the Fed's got them. The Fed's in a tough spot because the Fed's in a spot stuck between. They're trying to stop inflation. How are they doing that? They're trying to raise rates, right? There's a graph out there you'll see, and the line of how fast they've moved rates, it's like the line goes like this. It's almost as fast as the graph that shows how much money they printed during COVID, right? They almost these two lines kind of mirror each other.
That's interesting. So I mean, everybody knows how much money we printed during COVID, right? It was just like here's thousands of dollars for you, $1,000 for you. If you had a small business, here's money to pay your employees, or here's an SBA loan to keep yourself going. I mean, literally, it was just they were just printing money as fast as they could and putting it out into the market, and that caused this inflationary time that we've sort of run into. And of course, it had to, right? Like, I mean, you can't add billions and billions of dollars into the market and not expect for things to go up in price, right? Like, so, and then they're desperately trying to get the money off of the street, so they start raising the rates, and they raise the rates faster than they've ever done in the history of the world, practically.
Right. Exactly.
and that wasn't even working. And there's a need in order to kind of quell the inflation that they need unemployment to go up, right? Like, so it's such a weird system where the Fed is trying to kill the economy. Basically, that's what they're trying to do.
Because they want to stop inflation, correct?
Yeah.
But then with these couple of banks failing, they've actually put more money back into the system. So they're kind of like stuck between a rock and a hard place. They want to keep raising the rates. I think part of the problem is they acted too late initially, right? So they were trying to make up for lost time. And then also there's a lag. So you do something and you have to wait for those hikes to hit the system. And I think what we're seeing now is some of the reaction to that. It just took that long. So now they're talking about does the Fed stay its course, or does it say, oh my God, what have we done? Let's pause. And I've read two schools of camp, two schools of thought. One says you got to keep moving, because if you don't keep moving in your measured pace, you blink. You look like you blink. You look like. And then the other guy, which I didn't get a chance to read the whole article, but it was something along the lines of, you have to pause because now you've seen what's happened.
And I think they've already paused, right? I think they turned the money printing machines back on. And I know they're not saying that this bailout or this Fed insurance where they're going to bail out everybody up to all of their deposits, which has never happened in the history of banking, isn't a bailout. They're saying they don't have to print money for that, but it just doesn't add up. It doesn't make any sense. We had a question, and want to try and answer questions as we get them. So is the bailout 2008 is the definition of QE? What's QE, Bill? Can you answer this question?
Right. He's saying it is
quantitative easing.
It's 300 billion is what they're going to cover, pump in. And that is the definition of QE, which is stealth monetization. Essentially, it is the printing of money.
It's printing of money. I mean, they call it anything they want. And this,
right.
And this has been so wacky too. Like, we're not calling a recession a recession. We're not calling inflation inflation, and now we're not calling a quantitative easing. So we're just basically going to redefine everything in the monetary system and in our economy, right? So it's a pretty cute game that our government is playing. And look, I'm not trying to be over political. I don't think that the politicians have nasty intent. I don't think the Fed is against us. I think it's like you said. I think they've made some mistakes and they're trying to do the best they can to fix it. But this redefinition of words is really frustrating.
Yeah, it's kind of ridiculous.
This redefinition of everything, really, right? It's just like, oh yeah, we'll just call it something else, and then they get complete cooperation from the mainstream media, and so nobody knows what's really happening here. But sure feels like we're not doing as well this year as we were this time last year.
It's funny because I'm like, they sit around the room, right? All they do, they're all Fed bank guys, right? Like, nobody was like, all right, here's the plan. What is it? We're going to raise rates really fast to kind of stop inflation. Nobody was like, well, what happens to all the bonds that are priced, at a certain amount? Once you raise those rates, those bonds are going to lose their value. Like, nobody had a foresight or at the table to have this conversation. I mean, like, we're doing what we do all day long. It's like you go to a pizzeria and don't make pizza. Like, what are these guys doing over there? Like, they didn't think this through. 5 steps. You know what I mean? Like, it's like chess. They should have had at least a little bit of what's going to happen next. I mean,
you would have thought, and they did it so fast that, some of these banks had invested. They had to put their money somewhere. So they're investing in these bonds. And unfortunately, they're investing in these bonds as rates are going down, and they end up investing in bonds at the exact worst time that they could possibly invest in the bonds. And then as soon as they start raising the interest rates, the bond market is crushing them, right? Like, so it's it's really messed up. I know. Well, I don't know. I'm a terrible economist. Like, I zig when I should zag every single time. The one thing that I would say that I've been fairly good about is that when I see problems in the market, I've taken action. And so when COVID came, I pulled all of my real estate off of the market and I rented it all out really fast because I thought we weren't going to be able to sell anything. So I did it for entirely the wrong reason, but it worked out really well for me. As everything that I pulled off of the market is worth substantially more than what it was when I had it on the market back in 2020. And I think that goes to having a plan is always a good idea, even if you've got a bad plan. If you've got a plan and you execute your plan, you can still get through these times. And I wonder what you're thinking as you're a businessman who it's probably feels a lot like they've turned the water spigot off on you, in that, a year ago this time you were printing money, you were selling loans at a rapid rate, and now it's kind of just stopped, right? Like, there is no refinance market anymore right now. There is a very much smaller purchase market than there has been. So what are you left with, and what do you do when you're basically, you sell money?
Yeah, so it was definitely very good because of COVID, which we all knew was a flash in the pan. I mean, I've been doing this for literally, this is the company's 20th year, and I've been in the business probably 22 to 23 years, or maybe more than that actually. But we were very busy, obviously, and we knew. Okay, so my story is very long, and I got to condense it because there's so many twists and turns. Could we do another podcast on that or whatever this is? But it was very busy for the last couple of years because rates went down, right? We didn't see that coming. We actually thought, let's eliminate COVID from the scene. It's 2019. We were going into 2020. At that point, we thought there was going to be a natural interest rate rise a little bit, and then there'd be a cooling off. They were saying we might go into a recession at that point, and then COVID hits, and COVID really was this black swan, totally out of the ordinary kind of an event. I mean, literally, not since I guess the Spanish U.S.
Spanish flu, yeah, almost 100 years before, right?
Right. So we haven't had, it's not like anybody was really prepared or had gone through this that we're still alive. So everybody's in the same boat of how's this going to work? So rates drop. All of a sudden, people go, well, I'm going to refi because I'm sitting home. Why would I not do this, right? So we burned through all these refinances, and that actually put a lot of people in a very good position, right? So they're lowering their interest rate. The government's handing out stimulation checks, not just to both businesses and to regular ordinary people. That's a whole nother story we could talk about. But so money's coming in. People, if you look at the credit card balances, again, you can Google the graph. You'll see credit card balances actually were going down during COVID because people were able to bank some of that money, refinance their house, reallocate their personal debt. So households were in kind of somewhat of a good position. And now if you look, now that the stimmy checks have run out, credit card balances are starting to creep back up again, almost to the same trajectory when they went out and they came back. If you look at the line, it's almost like a carve out, and it's kind of like on the same trajectory because people's behavior hasn't really changed. People spend at the same thing. So where we are today is mortgages are definitely not, there's not as many originations as there were. I mean, we knew this was coming. What has caught me off guard is it's gone dramatically lower than I thought it would have gone. I thought we would have come back to what I'd call the line prior to, say, the COVID bump. We've actually gone lower than that, to the point that I've read that there's less originations happening now than there were in like the bottom of 08.
No kidding.
08, I was an originator that I haven't changed. I've been doing this forever.
Yep.
So I remember surviving through that time we survived on FHA because FHA never went away. And we survived on what was called DU Refi Plus and Freddie Mac LP Relief. I'm not sure if I'm getting the names right, but what they were to, if you were paying your mortgage on time, because remember, no way, a lot of people just walked away.
Yep.
Said, the house value dropped. I'm out of here. Here's the house. I'm done. So what Fannie Mae and Freddie Mac came up with was, we'll take an LTV and we'll throw it out the window. So prior to that, right, most LTVs are, traditionals, 20% down, 80 LTV. You also have FHA goes to 96. Fannie can go up sometimes to 97. But now we were doing loans at 150, 200. So at that point, I'm going, nothing makes sense anymore.
Yeah.
Nothing makes sense anymore. So, but it was a good product because what it did was it said, if you didn't walk away from your house, even if you're upside down, you stayed on time with your payments, we'll reward you by giving you a refinance and lowering your thing, even though your LTV is 150 upside down.
Right.
Those were the loans we were able to do during the 08, 09, before it started to kind of pick up again, right? So that allowed us to get through that period. Now it's less origination than even that. I'm seeing at my micro level, I'm familiar with at least 2 mortgage banking brokerage operations. I would say very small size. I would say no more than 20 to 50, let's say, originators, maybe 100 at the most. One of them is getting purchased by another company, a much bigger company, but it's really, they're calling it a merger, but it's really the bigger guy is basically almost doing what Credit Suisse is doing. They're buying them.
Big eats small. Yeah.
Yeah. Big is eating small for peanuts.
Yep.
And I know it, and I happen to know them because they're in one of the markets I'm in. And another one just went out of business completely. So you're seeing at the micro level, mortgage companies consolidate, go out, or struggle to make it through. I mean, we're hanging in there, but it's not as good as it was the last 2 years. And I would say if it stays at this pace, I mean, we could hang another year or so. But I mean, beyond that, you got to start asking yourself, what am I doing? Because you're going to start chewing and living through savings. And as a business owner, I mean, and listen, I mean, like I said, this is all I've really ever done for over 20 years. And even through 08, which was the world almost ended, we still made it through. So I have to think we're going to make it through this period, but there's no guarantees in anything. This is a weird time because, I mean, here's the thing. Here's a phenomenon that I'm noticing. So I'll ask you, let's just role play for a minute. Let's say you're a homeowner.
Mm-hmm.
You're in your late 40s to early 60s, maybe a little less, maybe a little older, let's say. You refinanced at 2.7. Okay, so you got a great rate on a house. And you're like asking yourself, where am I going to go? So if you sell that house, where are you going to go? Now you're going to get 6, 7 on the next one. You might make some equity because if you bought low enough. So what's happening is people are saying, I'll just keep the house and become a landlord. I'll hold this house at 2.5, 2.7 rate. Rent is still high, demand for rent, depending on markets, of course. But the markets I'm talking about, rent is there's still big demand. Northern New Jersey right now is the hottest market in the country for multifamily rental.
No kidding.
Hottest in the country, which is crazy. New Jersey's never tops any of these charts. It's always like, the Southwest, the Rust Belt, the Southwest, like, it's, I don't know, all of a sudden, because I guess proximity to New York, there's no development and nobody's selling. So everybody's just I'll just move to Florida, buy that house in Florida or the Carolinas, whatever, put down 10, 20%. I've got it. And I'll keep the house in Jersey. So there's no inventory. So all these markets, you have all these weird things taking place because of those wonky, never before seen rates of 2s and 3s, which probably, I don't know if we ever go back there. I don't think that was even healthy. I don't know if we should have ever gone there in the first place.
I don't know if you have a house, if you've got a 2.5 or 3% loan, if it's even advisable for you to sell that. I mean, all things considered, if you can afford it, if it will rent for more than you owe on it, wouldn't it be the better business decision to keep that money? I mean, you're talking about with inflation, free money, right? Like that's what I see. Like if inflation is 6 and you borrowed at 3, that's free. you're way better off keeping that money at least until the rates come down some, right? Like, and then the other thing is we unfortunately sold our primary house here in Puerto Rico late last year and thought, I'll just go out and replace it and it'll be easy. I had a lot of equity. We did really well on the sale, but then when I went to go into the market and look at houses that we would live in, I had to pay double what I sold my house for. So I'm losing on this transaction. So now we're living in an Airbnb apartment that we happen to, so luckily for us, we're not challenged when it comes to housing. We had places to go, but it's a scary market. If I have a house out there and I have a few that have a really good interest rate on them, there's no way I would sell them. And I would say the other thing is if I'm looking at buying a house right now that someone is selling and they have that kind of loan on it, I'm absolutely going to be talking to them about leaving their loan in place and letting me take it over. I'll just give them the equity. Let me just give you your equity in cash and let me keep your free money that you borrowed from the bank. And there's due on sale clauses and there's things but it's far better for me to do that. It's far cheaper for me to do that as a buyer than it is to go originate a new loan.
Well, and that speaks back to what's going to happen to originators. There's another piece of the market. If folks start doing wraparounds and keeping the financing in place, there's originations that dry up for us again, all because these are unintended consequences probably of bizarrely low interest rates from a black swan event that nobody really knew was going to happen. And, listen, to your point before, I don't think the Fed is like there's no like secret cabal I think these guys are a bunch of, guys trying to figure it out just like anybody else, guys, gals, whatever. They're in the room. I do believe they're really trying their best to figure this out.
Yeah.
I don't know if they're making the best decisions. I mean, it's easy for me to criticize, right? I'm not in the driver's seat. It's like, what's that saying?
For sure.
It's always easy to be the guy,
the backseat driver's easier.
I can sit here and say whatever. And again, I'm not, I don't sit here and claim to be some kind of master economist.
If you haven't hit the like button for us, go ahead and smash that like button for us. It really helps with the algorithm. So what do you think happens? We both live in Puerto Rico, and a lot of the people who will tune into this channel are living in Puerto Rico. By the way, connect with Robbie. Then I'm the flipflopflipperpr@gmail.com. If you want to connect with Bill, how do we get a hold of you?
Yeah, I would say acelandmortgage.com. If you go in there and click contact us, that stuff ends up in my inbox somehow.
Okay, so Aceland Mortgage for Bill and the flipflopflipperpr@gmail for me. So Bill, what do you think will happen with liquidity products that are coming to the island of Puerto Rico, and how long will it be before we get like a debt coverage service ratio or a cash out refi? Are there cash out refis on the island, even in traditional housing? What's going to happen with these kind of products?
What I would say that what's available, I don't know what the future holds, but I can tell you what's here now, what was here, and where we are now. So you have Fannie Mae and you have FHA here, right? I think Freddie Mac too, but for sure Fannie Mae and FHA. What does that mean? So Fannie Mae and FHA, I would consider your traditional full documentation, standard issue 30-year fixed loans, right? It's not going to be for someone who just opened their business 6 months ago, can't show any money, but's got $1 million in a crypto account. This is not for that. This is, you have a job, whether you're self-employed or you work at a company, and we have consistent documentation of your income over at least a year, 2 years. Okay, so we have those products. That's for purchase, that's for refinance, that's for cash out refinance, that's for primary, that's for second home, that's for investment. Okay. The negative, or what I'm finding to be difficult, is first of all, if you're over 80 LTV, the PMI in Puerto Rico is going to be higher than it is stateside. So you're talking about a little bit of a higher PMI charge if you're going over an 80 LTV. You can't cash out over 80 LTV, so it's really more on the purchase side. The other issue I see is appraisals. Okay. The appraisals coming in all over the map. There's no good, there aren't good comps. Or you'll see, I'm sure you guys have seen this, not subject to appraisal, right? This is half of the ads for houses for sale here. Why is that? It's for two reasons. The seller wants to maximize how much they're going to make. So I don't care what anybody says. I know folks were throwing pie in the sky numbers, throwing a dartboard, throwing a dart at a dartboard going, what is this house worth? And what are we going to sell for? I don't really care, whatever I can get, right? That's, if you're a seller and you're in the driver's seat and you've got people who are willing to pay whatever because they have fugazi money from, investing in Bitcoin in 2010, and they made $10 million, paying an extra $100,000 when you're up to $10
doesn't
million,
matter. Well, and even easier than that, if you move from New Jersey where you sell your house for $700,000 and you come here and you want to replace your $700,000 house with something comparable on the island, you can do that for half the money or less, right? Like, so you can come and buy a fairly nice house on the island. And if you overpay a little bit, or even worse, you sell your $2 million apartment in Los Angeles, California, and now you come to Puerto Rico and you want to buy something comparable to your 800 square foot apartment that you just sold for $2 million back in LA, you can overpay on something, and you can get something that was nicer than what you had there, pay less for it here. Right. And people were just throwing their money at it. And really that was right. What was driving the market. I mean, the stupid gringos, really, right?
I was not part of that.
Me either. I
don't understand overpaying and not being sharp on stuff like that. So it drives me crazy. But
it's kept me homeless. I just can't do it. Like, I see these things I want to buy and I know they're overpriced and I'm unwilling to do it. Like, it's not that Linda and I can't afford to buy something really nice. We could, but when it was $600,000 18 months ago and you're asking $1.5 million for it today, there's no way in hell I'm paying you that money for that.
I'm the same way. I'd rather just wait. I'll buy something else. I'll rent. I don't care.
Yep.
But it doesn't.
I'll go live at the damn hotel and pay $500 a night before I'll spend the money. You know what I'm saying? I'm not gonna throw $1 million away when I know the house is, it's 200-300% what it was 18 months ago. This is insanity. And we're already starting to see that stuff come down, especially in the higher end stuff. So
I
I
agree.
we looked at a house today that's on the market for like 650 now. It was on the market for 400 days. It started out at like 1.3 million, and now, a year later they're at 650. Yeah.
If someone bought it, good for them. You know what I'm saying? If you're the seller, you don't care. So
Yeah.
So here we are, fast forward. Appraisals have been tough, like I said. So what I've seen where you try to get an appraisal and the value's not there, and then that's why everybody's saying not subject to appraisal, because they don't want to be bound by what might actually be the reality of what the house is worth. Hey, too bad. If you want this house, I'm not going to, appraisal's 500, I want 600, find the extra 100, or I'm not selling it to you. But to your point, at some point there may be some sort of equilibrium that comes back. So those are two things you have to be considerate of when you're doing what I would call regular finance, the FHA conventional. Then we had non-QM for a hot minute. That's the DSCR. That's for investors. It's not here. Okay, it's on pause with a question mark as when it's coming back. I don't really know.
It really was a hot minute. It was what, a 90-day period of time, and maybe
it was summertime to winter. So I'd say
6 months.
Yeah, June-ish to December.
So really, the only thing that's out there that's not traditional housing money would be that 2 to 4 family multifamily, or just a house that you refinance, that you rent. Those products are still available to a guy like me. And for instance, you and I, we own a 12-unit apartment building. It's going to be very difficult for us to pull money out of that for now. But just down the street, I'm looking at buying a 3-unit. We could still get traditional money on that 3-unit. Is that correct?
1 to 4 family is your Fannie Maeable space, let's say.
Yeah.
5 to 6 to 7 to 10 of mixed use, you're out of the Fannie Mae realm. So a 1 to 4 for the other one down the street, there's a way to finance that with more traditional financing. Anything over that, 5, 6, 10, 12, whatever, it's going to be a real quote unquote, what I call true commercial bank that's going to do that loan. It's going to be true commercial terms, 5-year paper over a 25-year amortization, let's say 70 LTV max, floating rate with a prepayment penalty. That's what it is. People are like, I don't want that. I'm like, well, then you don't get a loan. Like, that's the way commercial banking works. So the rise of the non-QM product with this 30-year fixed term and a slightly higher interest rate than what you'd get on, say, a 5-year over a 25-year term. That 30-year fixed commercial money, that product that is no longer here, that was only here for a hot minute. That's actually a relatively new product across the spectrum. It's only been kind of around, let's say, the last 5 years, this whole non-QM thing. Now, it was out earlier than that, but nobody was really doing it. There was a bank in California called Impact that was doing it back in like 11 and 12. We were writing those loans. And they just went and became a brokerage. So they've been through the crisis up and down. They're older than we are. And they were a banking operation. They gave up their banking licenses and became a brokerage. That was very strange and eye-opening for me. I wonder what that says about the future of the market. I don't know, but it was interesting.
Bill, man, I think you were amazing today. So we're definitely going to have you back, do this really soon. And Adon and I need to talk to you about an event that we've got coming up. I think Adon sent you a text. So we'll get coffee and talk about that in the next few days.